They're going to try to put you into those company traditions. So we've had one where they had ice cream Fridays. So I did our little spiel during an ice cream Friday, but which was fine. And you get some questions like, "Our ice cream Friday is going to continue?"
It's not venture capital, it's private equity. It's the Private Equity Funcast. Pour yourself a drink and have a seat.
Welcome back to the Funcast. We've got a good one for you today with my friend and partner, co-founder, Ryan Milligan.
Many years.
First time on the video. So Ryan and I met each other in like 2005, and we started actively working together like 5 years later. So we've been like actively buying companies for 15 years.
Round up, 16.
16 years. 16 years. Man, I'm getting old. And in that time, like we bought like 25 companies and like maybe like 60 add-ons and everything. So today today we're going to talk about like, how do you even buy a company? So you started the firm, you've raised the fund, now you got to put it to work. LPs would call this deployment. So
stay on schedule.
How's your deployment going? So we're going to walk through the basics of this. Many of these things we're going to talk about, probably wind up doing like individual episodes about them, which we've done on the audio pod. And we'll probably revisit a lot of stuff because the market has changed. So first step one, like a quick history of sourcing. I mean, this is like go back to the 70s, 80s. The phone would ring. There were only a couple funds in the phone book. And it was like, hey, you want to buy a company? That was easy. Call that shooting fish in a barrel.
Except you need to have the money.
That is true.
Right.
Yeah. Once you have the money, it's like, how do you be a millionaire and not pay taxes? Step one.
Fishing with dynamite.
Step one, get $1 million. Step two, don't pay taxes. Same thing. Step one, get a fund. Step two, wait for the phone to ring. I would give my overlords and bosses in the 90s like a lot of crap because, now as they're LPs in our fund, like, hey, I was taking so long. I'm like, are you kidding me? Back in the 90s, you just look under W in the phone book and you'd be like, William Blair, call them. They'll buy a company. And today it's more hand-to-hand combat. So there was that. And then like Summit and TA in the late 80s and 90s, they popularized the reach out, cold call founders, develop long-term relationships, have
really
a database.
Operationalized it, right? Yeah.
Yeah, really turned it into like more of a science than an art, right? Tracked everything. And I'm sure if you saw their decks, they'd say, we knew this owner for 10 years before we bought their company. We passed the relationship on from partner to partner to partner. So that was like super innovative in the 90s and maybe even into the 2000s. And then it became an absolute arms race. So now you've got banks and banks of associates and analysts cold emailing owners of businesses, founders, private equity firms who they're trying to curry favor with and develop relationships with to unearth their companies. And there's whole software systems and email systems and tracking systems and reporting systems where it's like it is either a chunk of your Monday morning meeting. Where's sourcing? How are we at? Where we got? How many deals did we see? How many people have we met? How's it moving through the pipeline? All those things. Or it's its own separate meeting. And to the point where it's its own separate department in private equity. Right when we started in private equity, me before everybody sourced, right? Partner sourced, everybody sourced. And now it's like you've got a sourcing department. We can talk about whether that's good or bad. In our end of the market, I think everybody should source still. You shouldn't outsource it to somebody else. But you have entire sourcing departments. So we're going to talk about that first because if you can't find it, you can't buy it. So let's split this in between like when a banker or a broker has a deal versus like just trying to find it yourself. So I want you let's talk a little bit about like banker-led deals.
Yeah, let's just talk about, that part of the market. I would say, do you have representation? Is there an agent involved? That'll be the word that I'll probably use the most when you're looking to sell your company. So when you think about that space, there's lots of people out there looking to represent companies, and they do that just like a home agent or what it might be. They're looking to make a market, do outreach, do marketing, et cetera, and take a company. There's different sizes. I think the sophistication of the agent is directly related to probably the size and sophistication of the company. The bigger and the more sophisticated you are, the more you probably are looking at like a bulge bracket bank at the end.
So if you have a $100 million business, you're probably hiring a respected name brand banker to represent you to sell your company.
Yeah, because you're going to need a lot of help getting organized, doing the project management, and frankly, you're selling to a sector of the private equity market or a strategic that would expect a data room to be done and a lot of diligence to be done on that asset before they get after it. So,
and a bank that would take on $100 million business might not take on a $10 million business to represent it.
Yeah,
Just
because
like you're not hiring Sotheby's to sell a mobile home.
Yeah, and that comes down to incentives, and people have their certain thresholds that they need to make a certain amount of money on each deal at the end of the day. So yeah, that's how that works. So that's a direct correlation. Like the smaller, the less sophisticated you are, versus larger.
And what's the difference between a banker and a broker?
Brokers, there's really not. That's kind of categories that we put on them. Yeah. Both have broker dealer licenses at the end of the day. Brokers for us are people that are probably not as organized about like how targeted the target list would be. Like, who are we going to go out to? A broker usually skews towards smaller companies, and they say, hey, like, give me your numbers. We'll put a story around it, and I'm going to go talk to as many people as is necessary to see if I can find a willing buyer. They're probably not going to be as thoughtful as a banker would be about who they go out to. They're not going to be as organized. There's also a lower cost oftentimes for that type of representation at the end of the day. So
yeah, so if you like a broker, maybe we just do service businesses in the Southeast. That would be a broker, right?
Yep.
We represent staffing businesses and professional services companies in the Southeast. And we're 3 guys, and we've got a couple analysts. So we don't have all the resources to like do all the stuff a William Blair or Raymond James can do. But they might have like a really good niche in that space. There's a firm, that called Croft and Bender in Atlanta, and they're still great. But back in the 90s, they were the guys that if you had a software business in Atlanta or the Southeast, it was like, oh yeah, it's going to be good. They have a great reputation for all that. You may have a reputation in a sector, right? We just do software companies. We don't do anything else.
Yep.
Where like a big bank is going to be like, we have a software team, an energy team, an industrials team, a consumer team. So a broker is going to skew maybe regional or maybe industry specific. Is that right?
Yeah, and I think, and size and kind of approach. Like they have a CRM, they've got a bunch of emails, they're going to kind of blast it out there, see who's interested. It's almost like an opt-in model versus, go call somebody and say, you got to look at this one. I know you like the space because.
Yeah. So how do we manage a broker or banker or a typical private equity firm? How are we managing those relationships, or are they managing us?
Yeah, both. We have a CRM. We've got 600 or 700, I think, names in it, and you kind of match your cadence, your outreach to those based on how many deals they show, how active they are, the probability that they're going to show a deal that you like at the end of the day. So usually, there's usually tier 1, tier 2, tier 3. And you do an email cadence and you try to get calls on the calendar when you can, or what cities they're in, and you go catch up with them when you're in Boston, or they come catch up with you when you're here.
So tier 1 would be like, what's a tier 1? And this doesn't mean quality. This just means like how we would want to interact with them, or the frequency or intensity of interaction. So what's a tier 1 for a typical private equity firm?
Yeah, typically you'd say William Blair or Baird or Raymond James, but then I think you also throw in, there's lots of smaller shops that are, have a couple rainmakers that do 3 or 4 really good deals a year.
So tier 1 is probably a lot of volume.
Yep.
So you want to be in front of them a lot.
And they've got a lot of industry expertise, and we've got existing portfolio companies that they want to sell, and they know industries really well, and they put out a lot of good research. So just kind of high value industry conversations and, what's happening in certain markets. They also show up at trade shows. Like I'll be at a trade show next week, and every industry banker is at that show, and I'm meeting with all of them.
And they often have coverage guys, and that's
Correct.
Relatively new. Like when we both started, there weren't a lot of private equity coverage people at a tier 1 bank. So what does a coverage guy do?
They maintain the database of us. So they're turning that same rationale on us. They kind of break it up to say, at the end of the day, they do 2 things. One, keep track of what companies private equity owns so that they can pitch to sell them someday.
So they know everything in our portfolio. That's
Correct.
their job. Yep.
One, but 2, also what most of them also do, I think, is they help make buyer lists. So they would say, these 100, the industry banker who knows the industry would go to them and say, I've got this deal. give me your top names. And they'll kind of tier, like, who are we going to reach out to? Is everybody going to see it, or is it going to be a select group? So that's what a coverage.
Yeah. So they don't have an industry expertise, right? They cover private equity. They might have sectors or geography or size, and they're maintaining like, oh, hey guys, this deal might come up out of their portfolio, and we might want to pitch it. Let's make sure we stay in front of it.
Yep.
They connect us with the industry bankers. Obviously, we can go to them direct too, but they're the guys in charge of like, hey, they know everything that's going on at Parker Gale, stuff we own that we might want to sell, and stuff we might want to buy.
Yep.
So that's the coverage guy. Brokers don't generally have coverage people, right? You're talking directly to the owner or one of the guys.
Yeah, and that's part of the benefit. You get to know them over time, and you build up a rapport with them and a trusted relationship. And then, when you start bidding and when you have one you're interested in, you kind of know the main agent and the decision maker. So
let's talk about like a tier one. Tier two is just like maybe a smaller tier one or a larger smaller tier one or a larger tier three. So what's a tier three? Like what we would call a broker. Like, what does that look like?
Yeah,
what are interactions to them?
Tier three, it doesn't kind of give them justice either. Like for us, tier threes are great because that's volume, and it's just there's, we'll talk about, sourcing direct next. But when we look at our portfolio, I think it's 77% didn't have representation at the end of the day. So tier three, it's a little bit of a needle in a haystack, but we still want to see everything. And they're spending their days talking to founders, talking to small businesses, trying to find, these niche opportunities. They don't have as many per year, but there's hundreds and hundreds of them. So it's our job to just make sure they understand what we're looking for, what our requirements are, what type of deal we would do, because we want to see that. And then for us, like our side of that coin is will be a quick no and a faster yes.
Yeah. So tier three, in my view, is, well, here's one stat. Of all the 25 companies we've acquired as platforms, and maybe the 60 or so add-ons we've done into those, in any deal you worked on before we met and I worked on before we started working together, we've never bought two companies from the same source.
Right. There's so many sources, the math would almost have to work out that way.
Right. If you go higher into the multi-billion-dollar fund, they're a sector fund, tech sector fund, one of the big guys. They're likely buying multiple companies from the same banker, maybe in a given year.
Correct.
We've never bought two companies from the same source, which shows you just how many of these tier three bankers are out there. And again, tier three isn't a value judgment. It's just they might show us one deal every 18 months in terms of like what fits for us. I talked to a guy once at us, and these people are generally like, they worked at a tier two or a tier one bank. They left. They had some sector expertise. They set up their own shop. They got the broker-dealer license, and they just have a good reputation, and they're scrappy, right? I talked to a guy once, and I said, how do you decide who to go bring a deal to? And he said, Devin, I don't want to scroll the spreadsheet, which is basically like, if it doesn't fit on my laptop screen at 12-point font, I don't go to anybody more than that. Why would that be? Because he knows he has a good asset. Maybe he's a good chooser of companies to work with. 12 people creates a good enough competition to get it done. Going to 120 just makes his service level worse or doesn't make the probability it closes any better. And he needs this deal to close as much as the seller does.
And at that point, that's probably a pretty mature company. They already know the asset. People have been looking to buy it for years, and it's just more about brokering that process at the end of the day and doing a really good job with it.
Yeah. So real quick, as we wrap this up on this segment, what pros and cons of like sellers and buyers like to have representation? Like, why hire a banker? Why not hire a banker?
I mean, there's a cost to it. There's what do they really do? They get you organized. They do some diligence on your, they are putting their stamp of approval to some extent, depending on the broker.
There's some signaling.
The numbers.
There's some signaling.
I've seen this. I've looked at it. I've looked under the covers. I think this is investment worthy. I'm bringing it to you. There's a cost to that, right? And there's an expectation, like you don't know if it's going to trade yet. It's a lot of work to put a book together. It's a lot of work to do initial diligence. It's kind of like, I'm ready to go sell, or are you trying to find the right partner? And if the right opportunity came in front of me with a group I like, I would sell. How much conviction do you have that it's time to sell?
You don't casually hire a banker. If you hire a banker, you are going to market.
Well, and I would also say if you hire a banker, you want to sell.
Yeah.
Like you don't want to hire a banker and fail in a sell, because then most of the market's already seen your asset. They've got information on you. They're going to compare every projection you ever put out there against you 3 years from now when you go to sell again. So, you get this moniker of like, you're a busted sale. You tried to sell and it didn't get there, whether it's your fault or not. So, those are some of the downsides. I think we'll talk about it later. These bankers and brokers, to some extent, expand your list. In other extents, they might shrink your list. We can talk about that later. But there's definitely pros and cons. I think it comes down to level of conviction on, are you ready to sell or not?
Yeah, totally. Would you sell your house by yourself? Probably not.
Right. But if somebody came and knocked on your door and put a number in front of you and said, I'm basically taking this off the market, then you sell.
Totally. So let's talk about that. So going direct.
Mm-hmm.
So like you said, 80% of our businesses we own, there was no banker involved. Mm-hmm. Doesn't mean there wasn't interest in the business or competition, right? It just means they didn't hire a banker. So that's probably more likely. One, I think we're pretty good at it. We've been doing it for a long time. We've got a good reputation. But also at our end of the market, there are a lot of companies, a lot of owners aren't maybe ready to sell, and they're not like fully committed to being in the market. And we're just knocking on the door at the right time. Again, that's why you keep these databases. That's why you talk to everybody. So this direct to owner thing, what is it? Well, everybody knows what it is. You can buy databases. You can get companies' names. You can get general heuristics around size. How many employees are they growing? Are they shrinking? In terms of that, who's the owner? Do they have any funding or not any funding? Mm-hmm. And then you craft an email and you hit send, and now you're in the sourcing business. I would think now more than ever, these owners of businesses, of private businesses, are just getting carpet bombed by these requests from associates and analysts at funds, and even more senior people. So you're trying to just get in front of those people and like have an impact. AI is writing a lot of these emails, it appears, because we see some of them for our own companies we own. So here's what I've always struggled with is why would you outsource or give the authority to the person in the organization with the least amount of authority to do the most important thing for the firm, which is reach out to the owner of a business that you want to buy? I'm old school. Maybe I think that you and I should do that. Nori should be doing that. Certainly people on our team should be doing that, but it shouldn't be their main activity. They should be helping us figure out who to reach out to, and then one of us should try and reach out to them. Another way we do this, so we do the cold calling. I'd say I'd want to call it warm calling, right? We're trying to get an executive introduction. Everybody that owns a company has friends. Everybody that owns a company has advisors, employees, people in the industry that they know. We want to get close to those people so those people can get us close to the people.
Yeah, think about it. It's how do you establish credibility?
Yeah. What do we talk about internally? We call it how do we scale intimacy, right? I want the founder of a business we reach out to or get introduced to feel like, oh, I'm having a conversation with a trusted person of somebody I trust.
And it helps if it's a decision maker and somebody who can speak for the firm.
That is not to say a junior person has no business sourcing. We tend to believe that sourcing should start at the top, not start at the bottom. Another way to do it is have really good relations with executives. Executives meaning CEOs or board members or established, successful executives in your industry that who trust you, who want to introduce you to their friends or the people they know in the industry when it's time to sell. We got a lot of like, hey, Devin, hey, Ryan, can you talk to this guy? He's not sure if he's ready to sell. He doesn't really trust lawyers or bankers. He gets a lot of emails. Can you just like walk him through like what it might be like? And I think we're good at that because we're not going to accidentally buy his company. He's not going to accidentally sell it to us. So it's just like, yeah, let's have a conversation and do that. That has led many times to 3 years later, the phone rings and say, hey, I enjoyed that conversation with you. My good friend introduced me, so I trust you. Like, can we figure out if this is going to work? And I don't really want to hire a banker. Like, if you can kind of get to this price, probably pretty good, right? Obviously, there's a long path after.
Well, yeah, and I think similarly, at this point, I say 80% of my time sourcing is spent with executives for two reasons.
Not the owners of the businesses. So
no, executives who know a space.
Yeah, so tell me more about that.
This would be somebody somebody who knows a space, knows it cold, somebody who's run a private equity company before successfully and wants to do it again. Those are really the two major reasons. And that's mostly because, well, one, they could help us do a deal if a deal comes on our radar.
So a broker calls us and says, hey, here's a deal in the oil exploration software space. Your first thing is like, oh, what executive do I know who could look at this with?
Right.
Yep. Okay.
And they know a lot of companies, and they might bring you a company that they want to be a board member or advisor to, or oftentimes they bring you a company and say, I want to run this.
We get the call where I've tried to buy this company a few times when I was at the other big guy in the industry. They never were going to sell to me. Now I'm on my own and my non-compete's over. I think the guy might sell it to me.
Right.
Right. So these executives have a ton of credibility because they know the space really well. They have relationships and people trust them, hopefully. Right.
Mm-hmm.
We have credibility because we have a checkbook, because most executives can't write a $50 million check to buy a company. We can. So that is a great relationship. And to get walked in the front door of somebody like that, of an owner with an executive like that, our view, where we play and how we conduct our business, that's absolute gold.
Yep.
The next one, step down, would be we just establish a good relationship with an owner of a business over time. We're doing this hundreds of times a year. We do 1 or 2 investments a year. So like you can think of the funnel and how things get triaged down to that. But if you do that every year, year in, year out, eventually the phone's going to ring and somebody's say like, hey, could we run this by you? Or a banker is going to call you and say, hey, we know you know this business. Do you want to take a look at it? We may be like, ooh, it's going to be competitive, a lot of people looking at it, but at least we have a leg up because we've been talking to that owner for a while. And that's why I think the big funds do this, like a lot of cold outreach and talk to businesses all the time, because they say, oh, we've been tracking this business for a while. We could move faster.
Yeah, they know what to expect.
Yeah.
Let's talk about you want to talk about the pros and cons of this approach though?
Yeah, I think the con is like you kiss a lot of frogs.
Mm-hmm.
And I don't mean, frogs. Let's just call them frogs. I don't mean that in a bad way, but like there are a lot of businesses that.
Well, there's some that just aren't a good fit, right?
Yeah, like it's a good fit for somebody, but not for us.
Yep.
And you don't know that because all you've seen is their LinkedIn page, their website, and some rumors that it's a good business. And then you get talking to the founder and you're just like, wow, it's way too big for us, or wow, it's way too small for us, or the metrics he's giving me sound great, but then I get a little more information and it's not kind of holding together.
Yep.
What we love about founders is they're eternal optimists, but they're often telling you like, hey, we're 10 million of ARR. And then you get in there and you're like, you're 4. He's like, but I'm going to be 10 someday. Right. And you're like, well, it's a totally different conversation at 4 than it was at 10. So that's it. I kiss a lot of frogs. I'd say that's the biggest thing, right? You have to be very comfortable with the fact that most of your work is wasted and that it doesn't turn into a deal. I would say it's not wasted because you're making friends. And that's the pro of it is you meet a lot of really interesting people. Like founders of companies are some of the most interesting people on the planet because they bet on themselves. They're super optimistic. They had a vision. They executed it. And they're at a place where, a very vulnerable place. I think it's time to sell my baby.
Yep.
And if you treat that relationship really well, I think you get a lot of karma and a lot of, you're just, things just grow from there.
The other variable that I focus on for this, positives and negatives, is just time. Like if you engage with a founder, it's probably going to take longer to get through that courting process.
Yeah. Because there's no beginning, middle, and end like with a bank.
No, there's not a break. Well, one, they're not sure if they're ready to sell.
Yeah.
They're not ready for diligence. And back to the agent point, if you're engaging directly, the market clearing price is going to be an interaction between one buyer and one seller.
Yeah.
And they're going to see a price and they have another price in mind. And then it's this, okay, let's do some more. And then it's this iterative back and forth. And it just takes time to get them comfortable. What are we going to do post-closing? You do more work and you kind of go from there. So
a direct deal, the bid-ask spread could be, you could put a Walmart parking lot between the bid and the ask.
That's the biggest reason also, I think, why some firms choose to set themselves up to participate in, like, they call it bid the book, like auction processes. They're set up for that, to know what they like when they like it, put a bunch of resources against it, get it done. If you're going to do founder-owned businesses, you're going to spend a lot of time getting people comfortable with you and who you are. You're going to be very willing to be transparent and vulnerable. You're going to be giving them lots of references. You're going to go to a lot of dinners that you may not have to do with a banked process because they won't even let you.
Before you even know what the numbers of the business
Right.
are, because
Right.
the founder doesn't want to tell you yet.
Correct.
So you may do all this great stuff, develop a great relationship, and then they tell you actually see the numbers, and it's wildly different than what was represented.
Correct.
Usually worse, rarely better. Not a bad thing. Again, these are optimistic people who like want to show their best foot forward. And then you're in that really weird position where you've developed this great relationship where there's been trust and vulnerability and respect and all this stuff. And then you're like, there's no way I could do this investment because the
Right.
numbers don't add up to where the expectations for the valuation are. And then you have to let these people down really softly so you don't come across as like a jerk. Oh, you wasted all my time. You did this, you did that. So it gets
Right.
really delicate.
And I think we're going to get more into that when we get to winning over the seller. But before we get to that, why don't we talk about, you want to hit a thesis? real
Yeah,
quick?
I'll do it super fast. So
Yeah.
like, why would you said firms that bid the book, right? Like, hey, we're not going to go chase all these companies. The market's going to clear. Banks are going to call us. They're going to show us stuff. They're very high quality businesses. We want to buy high quality businesses. The reason you could move fast in one of those is because you had a thesis, right? And a thesis just means a research project. We really like vertical software. Okay, that's a start, maybe a little broad. We really like vertical software in the energy space, in financial services, and in aerospace and defense. Great. Okay, those are three discrete theses. William Blair calls you, says, hey, we've got a $50 million ARR founder-owned business in the aerospace and defense industry. Great. You are ready to move fast. That's one. That's one reason to do a thesis. Another reason to do a thesis, and I think why you and I generally have one running at all times, is it just makes you busy. Like if you're not a lot of deals in the shop.
We call it heating up molecules, right? Like
Yeah, you're just
there's luck and found luck, and those are two very different things.
Totally. If you're sitting around waiting for a banker to call you with a new deal, you're living and dying with where the market is. If you've developed a thesis or an inkling or a hunch, hopefully with an executive working alongside you would be great. But even just on your own, it gives you something to do when you come in. Instead of waiting for the phone to ring, you're like, oh, I've got these 5 people to talk to. I can learn about the industry. And then we heat up these molecules. When you heat up molecules, they bounce into each other faster. And when things bounce into each other faster, you're just like, oh, all of a sudden I'm the expert on aerospace and defense vertical software companies because I've talked to all the people in the space and people are now calling me and running things by me. That's like the whole point of a thesis. Plus, to your point of like, you just want to work with executives who know companies who can introduce you to them. You just meet executives. And a lot of the good ones are talking to a lot of us all the time. And they can filter, oh, Ryan was really smart. Ryan didn't waste my time. Ryan was thoughtful. He did his homework before he got to me. He gave as much as I gave, right? So I feel like I got smarter through the interaction. That's really the whole point. We've done podcasts and writing about how to do a thesis, like from scratch.
Yep.
We'll do it again. But again, I'd say that would be like an addendum to the sourcing machine.
Yep.
All right.
So yeah, why don't we talk about how you win people over? I think, and in general, focus here probably be heavily weighted toward our part of the market. So not the playbook to win an auction, but more of the, when you're getting into these interactions with
how does a private equity
founders
firm win you over, Ryan, given that most of our deals wind up in other private equity firms' hands? It's like
persistence.
Exactly. It's like, don't waste my time, be polite and have a sense of humor. That's a good start. But how do we win over the sellers?
Correct.
Is right. So yeah, walk us through like your
I think,
your playbook.
just to kind of set the table for this. So like what matters, when you're thinking through this. So, I mean, obviously at the end of the day, the elephant in the room is somebody's got a price in mind and you've got a price in mind. So, at the end of the day, you got to hit a price that makes sense to somebody and they're willing to sell for.
Yes.
And that's a very iterative process in the founder-owned company part of the market.
And you can differentiate yourself right out of the gates with a really high price.
Right. You can.
You can.
But yeah, we'll talk about that when we talk about LOIs and IOIs and things like that. But really, anybody can put a price on the table. The natural follow-up question is, how certain are you of this?
Yeah.
How sure are you? So there's kind of this dance in this contract that's being written as you go is how much do they know? How much do I believe them? How consistent are they? How transparent are they? Are they actually going to be there at the end?
And back to a banker-led process, the banks have gotten smart over time, and they've got a spreadsheet of every bid you've ever done and whether you lived up to the bid or not.
Yeah,
So-
and they know, are you and some people build into their bids and it comes up over time. Some people just try to get the meeting and it goes down over time. So reputation matters in all aspects, but you're documented in a banked process.
Yeah. So the obvious ones are price, terms.
Mm-hmm.
You give me the price, I'll give you the terms, right?
Yep.
Speed, I can move really fast.
Yep.
We always close. We have 100% close rate or whatever, certainty,
Right.
We're going to do this.
Yeah. And some of that comes down to trust. Some of it comes down to resources.
Yeah. May come down to like, we've looked at every business in this space. We've owned companies in this space. We know this really well. We're going to do it again. We've got an executive who we're, working with closely. So those are like kind of the obvious things. What about squishier, like relationship and trust? Like what does that even mean when every website in private equity says like, we build relationships. We partner with management.
Yeah.
We're founder friendly. We paid $2,500 to Inc. magazine to put us on their list of founder friendly private equity firms. So like, how do you win over the seller? Banked versus unbanked, maybe.
Well, for banked, it's kind of keeping up, right? Like in banked, you're on somebody else's timeline, right? So they have a process in mind. They have a certain amount of work you're supposed to get done in what time. So like we'll talk a little bit about IOI. IOI is like an early bid. LOI is like a later bid. But in a banked process, they're saying you got 3 weeks. Here's a book. You got 3 weeks. You can ask questions. You may or may not have access to management. And if you're serious, you should be getting as much work done as you can to firm up your bid before, as you go. Now on the private equity side, you're like, well, I don't know the price yet, so I want to manage my resources before I know what that is to see if I still want this, right? So
and the banker's going to say, well, we're not there yet. We're going to, we'll get indications in a few weeks and we'll give you some feedback. And again, that's back to your point earlier around why do we talk to the banks in a tier 1, 2, 3 kind of cadence? Why do we talk to the coverage guys? If you're the first time you've shown up in a process with a bank.
Yeah, they don't know you.
They don't know you.
But a bank's always going to be looking at engagement. Like they're in the back end, they're looking at the data room. They're looking at, well, there may not even be a data room yet, but it's like, have they sent a question list? Did they do a call? Are they good questions? Are the questions relevant for the industry? Or are they all over the place? It's like, we own a couple businesses that serve auto dealerships. If the first 3 questions are like, what's happening with auto consolidation, and aren't the OEMs just going to take over the auto dealer industry? Probably not somebody who's been looking at the space for the last 5 or 6 years, right?
Totally.
So, they're looking for ability to move, knowledge, certainty. Like banks at the end of the day want their lives to be easier because, well, that happens to be synonymous with like, can they get this done? Will they get this done in a rational time frame? So
yeah, they have money. We've worked with them before. They've done their homework. They do what they say they're going to do, and they're good owners.
Right.
That would be a great way to differentiate yourself in a banked process.
Yep.
Right. I would say, you can work the refs, whether it's direct or with a banker. So working the refs would be calling the banker after the call you had with management, or making sure they know, hey, we're really serious here. We want this. Hey, we're not the highest bidders all the time, but we're dead serious. We're great to work with. Hey, give us a chance. Tell me where I need to be at the first indication process. And then I might be on my tippy toes. So they know like, hey, you bid, but you got to confirm the bid because it was a little high.
Yep.
Or you just say like, guys, we're out. Right. So I think, that's helpful with bankers. How else do you differentiate yourself in a banked process?
I think we mostly covered it.
Or how else do you work the refs? How do you work the refs?
Well, yeah, there's kind of 2 approaches. Some people I think bid to get a meeting and then they figure it out. Other people bid you can try to get information back. So don't bid too high. Like try to find, they're saying we're bringing 8 groups through. All right, try to be number 9. See if they try to move your bid up and how much. So if they're guiding you to $40 million purchase price, bid 36.
And then
see if you get in or they bump you up.
So what happens? They tell you they're only bringing 8 groups through. The clearing price is 40. You bid 36, but you get the call. You get a call from a banker.
Call say, hey, we got 8 groups, but you guys are a good fit, and we know that you stand behind. And you're not doing it just to play games. You're like, I want to bid something I would be excited to run as fast as I can to close.
Yes.
If it's you versus a group that tends to bid a lot without conviction, you get the call and they say, hey, you're 10% off, you're whatever. Yeah, 10% off. If you can bump your bid 10%, we'll get you in the meeting. And we tend to, like when we are in a broker, it's never 8. Yeah. Like there's broker processes where there's like 3.
Right.
And we usually put forth a bid that we say we're there. And actually, if you turned it into an LOI, we're ready to sign that and do 30, 40 days of work and close.
Yeah.
And we have conviction. And they say, you're a little off. And you say, all right, we'll go to that. That's, we're getting close to our tippy toes. But hey, let's get all the information and let's see if we learn more that firms up our bid or makes us more convinced or more convicted at the end of the day. So our bids, I think, tend to go up. Yes. When we do move through brokered processes, not down.
Because if we're bringing our bid down, we're basically saying we're out.
Yeah.
We found something.
More of a binary thing then.
So don't even lower your bid.
Right.
That would be our strategy.
Yeah, we're kind of like we either want it or we don't, and that 10% isn't going to make or break it. But
so here's what you want on that call, I think. Hey, Devin, you've done the most work. Management loves you. You've got an executive they're excited to work with or step in to run the business. You're a little low. Could you come up a little bit and you can get the meeting? Well, who else is in there? Well, we're only taking 3 groups. Mm-hmm. One of them, we don't know that well. They haven't done a bunch of work on it. One of them has done deals in the space before. They know it really well, just like you guys, but management didn't like them as much.
And then we got one high outlier bid and it's a search fund and we're not really sure what to make of it, but it's a really good number. And
exactly.
And we got to figure this out.
We also get the call from time to time in a banked process, which is like, you guys said you're on your tippy toes. Like the clearing bid to get a meeting is twice as high as the bid.
No, exactly.
You bid 40. We have 20 bids at 110.
But in that situation, I've called the banker beforehand and I said, hey, I'm bidding this. Yeah. Do you want me to put it on paper? Am I making your life easier or harder by doing that? And I'm telling you I'm doing this before I do it because I don't want you to be mad at me.
And what would the banker say? Why would he say yes? Why would he say no?
I mean, it depends. Sometimes they want the volume and they want to show that they did their job. Sometimes they're like, I'm always like, I'm not trying to offend anybody. I'm just telling you, like, it's not even about the value of the company. It's like the fit for us and how we're going to approach it at the end of the day. So it kind of depends. Sometimes they're like, yeah, it's just, I'll have to change the PowerPoint presentation and make the football chart a little wider. So like, just, no, we're good. Or they'll say, throw it in and we'll, then they know. Maybe that's useful to them to say like, hey, some people think this. Like the market is seeing it differently.
Or there's a tighter process with a tougher asset and the banker's like, I want you to give it to me. The seller's probably going to say no, but at least he knows where the market is.
Right.
And you're not wildly different than anybody else. So I need it on paper because he needs to know it's real. And give me a few weeks and we might come back to you.
Yep.
Right. So it's a smart move to call the banker rather than just throwing something over the fax machine and saying, here's where we're at. Tell me if I'm in or not.
Yep. Yeah. So how do we differentiate when it's more of a one-on-one conversation?
Oh man, throw the kitchen sink at it. Everything. Where did they go to high school? Where did they go to college? Who were their friends? Where do they play golf? Do they play golf? Are they into guns? Like what can I find about anything about this founder? How do I get close to this person? Again, you've heard me say this a million times in meetings, and I've probably already said it 3 or 4 times on this podcast, is every owner of a business we want to buy is a human being so far that has friends, that has colleagues, that has employees, has ex-employees, has people that used to work at the business, people currently at the business. Do we know any of them? Can we get close to any of these people? Again, not to get information, but to get social proof. Hey, these guys are worth talking to. You're going to really like the team at Parker Gale. Hey, I know, you're not ready to sell, but why not have a call with somebody? Mm-hmm. So we're pulling out all the stops where we can. Stopping it being creepy or annoying, I guess. Creepy is, and we've seen creepy, where people like show up with like weird gifts or something that like they're deep in this person's social media feed. That would seem a little creepy. That's happened to us with the podcast at times, where it was like, okay, this person's doing a lot of research on us. Very nice. But like that could come off the wrong way. Or persistent, meaning like, hey, I haven't heard back from you from the 47 AI, generated emails I've sent you. Why haven't you called me back? I have $10 billion under management. I've done all these great deals. Like that just comes across as annoying. And we've seen those emails too. So again, I just want to, it's the 6 degrees of Kevin Bacon I want to be as close to this person as possible with people around them saying like, you really should talk to Devin about this. Have you talked to Nori at Parker Gale? She really knows this stuff, right? That's kind of what we're trying to do. That is the differentiator of winning over the seller. To your point earlier, is just like the being smart, knowing how to ask questions. We had a conversation in here earlier with the team around how you write the request list questions.
Yeah,
just as basic, like
take the edge off.
Who's sitting around like wordsmithing request list questions? Because you could come across as like make the person very defensive with how you ask the question, or make the person feel good about themselves. Again,
well, you also want to be efficient. Like to the extent available is a phrase we can use.
We are not trying to buy this company in my first interaction. I am trying to be memorable. That's it.
Yeah, and this is a wish list of information that allows us to be as credible as we can to give you an indication of a price or a price range.
And a founder might say, I've got a data room. I've pulled it all together. I've done this before. I'm ready to go. Like, let's talk. Rare,
yeah, right.
That could be possible. And some of them are like, I'm not even sure if I'm going to do this. I don't have anything pulled together. And I don't want to tell anybody on my team we're even having this conversation.
Yep.
Those are two very different conversations. In the former, I'm like, okay, like this is real. Like, let's go. It feels more like a banker process. Let's jump in. Let's dig into the data. Let's be efficient. Let's be transparent. Don't string them along for a month and say like, the market's too small. The company's too small, right? Get to the answer pretty quickly. Or like, hey, I need more. I mean, we're in these right now. I'm in the middle of one right now where it's like, hey, I'm still waiting on some information that probably requires a couple people on your team to know. It's totally fine. We can do a bunch of desk work, but that's kind of the gating item.
Yep.
And he knows it's going to take a few weeks before we get there. Or if on the latter, like they don't want to tell anybody, and it's quite like like I said, I'm just trying to be memorable. Like I really like that. I really like that Devin. I'm going to keep talking to him. He cracked me up.
To that point, the other one that I'd add on, kind of yes and for you saying you want to get to know those founders, that's a two-way street. So how you want to make yourself as transparent as possible for them to get to know you. So how do you do that? You have a digital footprint, you've got a website, you've got the podcast is a perfect example of that. It's like, go listen to the podcast. But I think transparency goes both ways. And how you're approaching that process. There's our CEOs deal with this a lot from other private equity firms, and they get on the phone and they're kind of getting information that feels very transactional.
Yes.
Versus somebody saying like, this is who I am. This is why I'm talking to you. This stage one, I don't know if I want to own your business yet, but this is why I'm talking to you. And this is how that would look. So kind of laying out the process for them. Let's understand you and your motivations and what you want to accomplish. Why are you even talking to me? Why'd you take the call? Next, it's kind of like, okay, we do know this space, or we'll figure out this space. And if you want me to start to put a signal for like I think this might be worth, if I could get these 3 or 4 pieces of information, I can probably do that. And then you kind of walk them through the process from there. But this gets back to my time element. Like you're putting in the work. Like not everybody, there's no direct incentive for us to do that other than one is kind of the right thing to do. It's how you build a relationship with somebody. I think that's a big signal for like, is this firm a firm that does this a lot? Like, does it feel like they're trying to understand my ARR, on the first call, ARR, revenue, gross retention, net retention, EBITDA, cloud stats, all that. All right. If that's happening to you, you're probably getting plugged into a CRM.
Yes.
To see if somebody else who's a decision maker wants to talk to you. That's totally fine. And that's a necessity for larger firms in our sector of the market.
It's how a lot of people
run way to do it.
It's how a lot of people run the play. Totally understand. It's a high volume shop. They need these stats. The associate needs these stats to put in the CRM, to get a sheet to put in the Monday meeting for everybody to discuss. Not the way I would, try and buy a founder-owned company outside of a process. I would try and get close to them somehow through a relationship, get a warm intro. I would say, this is like, they're not thinking of selling yet, but I've got an introduction.
Yeah.
I may say, I'm going to be in Boston in a couple weeks. Let's go grab dinner. Right? That may be too much time to spend with people. We've done that. And it's like, oh my gosh, 10 minutes in, like, this is going to be a long dinner.
Right.
So let me just like have fun and, be helpful. But we waste a lot of time on that, but I think it's good karma. Or I want to be helpful. Like, hey, let me tell you how this probably goes. Here are some other firms we know. Let me be helpful where I can be helpful. And then also, you and I can look a founder in the eye and say, other than 2 carve-outs we've done, we've done 23 investments. So we've done 25. 23 of them were family-owned, founder-owned software companies. This is all we do. So I don't know your industry really well, but I know a lot about what you're going through and kind of what you care about and what you want this transaction to mean and look on the other side. Or I've done a lot of work in your industry and this is all we do. And you're talking to the owner of the business, my business.
Yeah.
You and I can say, you're looking at the owner founder, you're the owner founder. And again, you're just trying to build trust and that somebody says like, you know what? I want to talk to that person again. Maybe in a week, maybe in a year, maybe in a decade. That's what we're trying to do.
The way I think about it, I don't know if you agree, is first like industry. Because if you're talking to a founder, you've at least, what their company does and what industry they're in. Yeah. But then it's really situational relevance, like fit for is this the type of situation that would work for us? Which is why the first call with us, like we already know we like the industry. We're just figuring out, is this a good fit for us? And then you get into the particulars.
Yeah.
From there, but that's kind of the order of operation.
Totally. Let's jump into some technical stuff.
Yeah.
What do you say? This isn't like the lingo podcast we've done, and we'll do another one, but like IOI versus LOI. What do they mean and why should I care? And what does that mean to you in terms of like the process?
Yeah, I mean, both rely on faith a little bit, I think, right? Like the IOI versus LOI to me is how much.
IOI is an indication of interest.
Yeah,
and then LOI is a letter of interest.
Yeah, and they're kind of interchangeable. Like basically, I think most people define an LOI from an IOI as does it have exclusivity in it? Meaning, are you the only one that's talking to them from that point forward? Yeah. But they're really just signals of how much work have you done and how definitive is your bid. Now, neither are definitive. Usually, particularly in the smaller end of the market.
Yep.
There's not breakup fees. There's somebody can sign an LOI and pull out 2 weeks later and you wasted somebody's time and maybe a little bit of money, but there's no penalty for that.
Yep.
In a founder-owned situation, the early dance is kind of getting into IOI, which can be verbal or a piece of paper, which is you're looking at a space, you're doing some information sharing, you're figuring out, does the situation fit? And it's like, I think, I'd kind of be at X.
So the founder at some point basically says like, hey, we've been talking for a month. Like I told you I wanted 50 million for my business. Like, are we close?
Yeah.
And that might be, you're not writing that on a piece of paper and signing it. Maybe you are, maybe you're not, probably not. But that's kind of like that stage. You've been doing some work.
We're kind of at 4 times revenue. We're probably at 40 to 42. So there's a gap there. Like, is that something we want to continue to explore? That type of thing.
Yeah. What about in a banked process? How does an IOI play, and how much work have you done before that? Or are you?
Well, there's a lot of work done for you. So there's a book, and there's a lot of information in that book, and there's not a lot you have to do because they've defined. You've got their historical growth, you've got their margins, you've got their net and gross retention rates, you've got the management, their growth plan, whether you believe it or not. The banker's giving you guidance probably half the time, which means they're saying, we're kind of thinking this is or we're hearing from the market, this will trade here to here. So there's just kind of a lot more information.
You have summary financials. Maybe you have a redacted customer, like top 10 customers, like
by customer A, B, C, D.
But you don't know who the customers are. You don't have the customer queue.
No, but concentration. So you have, but you're really deciding. Do I want the banker's using it? Are you going to get access to management, which takes like a day and a half out of their time? Yeah. By the time they travel somewhere, have people travel there and do a 4-hour meeting and a dinner.
Yeah.
So they're trying to manage people's time based on your bid. Like the middle part of the process, which is where somebody then gets deeper and says like, do we think we have a shot at this or not?
So they went to 100 people and they're trying to get it down to 10.
Yeah, and they get 20 bids and 10 get to meet.
Right. And that may be a whole mix like we just talked about.
Right.
Could be price gets you there, terms get you there, familiarity gets there, relationship with the banker gets there. You get that phone call, hey, I need you up 10% because then you can get in, and we'll bring a 9th person to the management meetings. And then it used to be you could talk to management often before an IOI,
and sometimes you still can.
But mostly in a tier 1 banked process of a private equity owned asset, maybe not a founder asset, you're probably not.
Right.
That's the sorting hat step.
Yep.
You're either Gryffindor or Hufflepuff at that point. And,
Right.
There's nothing you can do about it.
And then what happens at LOI? Well, you've met management and you're meant to, again, there's a scale of it. The bigger the scale, the bigger the private equity firms, the bigger the asset, kind of the easier it is to underwrite to some extent because it's got more heft.
Yeah.
It's easier to get lending. They have a legal contract that you mark up and submit with it. So really, for a very large process at the LOI, you're mostly probably saying, I'm going to do this. And honestly, those firms have to put their reputation on the line because at that scale, if you sign an LOI and it's pretty definitive and you don't close, like unless there was something unknown, that's not a good look. So that's pretty definitive at that point. Probably gets a little more interesting when you talk about our part of the market because there's a little more of a dance between we think we're at X and getting to an LOI.
So how are you? Are you sending signals through the LOI somehow? How is this document like? You read between the lines. What's it really saying?
Yeah, I think. Well, little phrases you should read. So if you're getting to an LOI and it's a one-on-one, you're talking directly to a founder. There's probably a request list. We're trying to get as much of that information as we can. Some of it's available, some of it's not. Like Customer Cube is just these. It's like we've done a download from Stripe.
Yeah.
And created that from scratch.
We are doing one right now.
Yeah, we're usually getting an Excel file that they've taken a shot at, but then contract dates and all these things don't line up. So we're like doing a bunch of work on it. But reading between the lines on the LOI, little phrases like subject to the information we've seen to date, or things like that. As the seller, what information they have, right? It gets into the lemons prop, like everything, they don't know everything, or they know what you've given them and that type of thing. So the more information you're able to get pre-LOI, the better, the firmer the bid is. That's where the questions about what diligence are you going to do, what have you done, what haven't you done is important, and we try to be as transparent as we can about that. Like there'll be times where it's really hard to get this Stripe download. We've got a sense for what retention is. And they're saying, well, I got to ask so-and-so to get it. I don't want to do that. You're like, okay, that's fine. Like not ideal, but we'll do it. But understand that there is more risk in this bid because I don't know what I don't know yet.
So the signaling there is like, this is still a little squishy here because I don't have everything.
Right.
Right. And that's okay. They're also going to be signaling in, we're going to do all equity in this deal. We don't have to raise debt.
Yeah, that obviously makes it less risky.
So that would give you certainty, right? Something you want to differentiate yourself with. Maybe
and another step that they don't have to take. They should be able to move faster.
You could say, we could close in 2 weeks. We've seen LOIs on companies we've owned. We can close in a week from the LOI. And you're like, oh my goodness. Okay. And then we've signed LOIs with family-owned software companies where we had 100 days of exclusivity. So like, that's really squishy. It's like, hey, based on what we have today, we could pay this price.
Yep.
We need 100 days to do the work to get there. Again, we're going to keep you posted along the way, but like, it's going to take a while. Why? Because they don't have a CFO.
And they don't have a data room and it just takes time. Right?
And the guy who owned it, who isn't running the business day to day, his son is, or an employee is, it's just like, show me the money. I don't believe it unless it's written down. Okay, I guess we're writing an LOI. Let's keep it pretty squishy. Right. Or in a very competitive process, the LOI is basically all about certainty and speed.
Yep.
Yeah, like we will pay this price on these terms. We don't need anybody's approval. We're not using debt. We'll close it on our line and we will close in a week. That's a move.
Yeah.
And it's a very powerful move.
More typically for us though, I'd say the IOI kind of evolves to the LOI, meaning there's kind of that initial conversation about price and there's a gap.
Yes.
And they say, well, I think I'm worth X. And you say, I think you're worth Y. It's like, okay, well, let's just go do some more work.
Yeah.
Okay. So then the request list gets a little thicker. It's like, all right, let's see this, and this, and that'll help us sharpen our pencil.
Yeah.
I've had the time from submitting the first LOI to signing an LOI be 75 days.
Yeah. Yeah.
There's a level of patience. It's just, but that's not like, that wasn't contentious. It's just like, well, all right, let's do some more work and then let's see where we get.
Yeah.
And it's not like we're working throughout that time period.
Yeah. Yeah.
But we ask for information like, oh, I can get that. And it actually took a couple weeks to get it. So then we look at it and we get it. And it's just becomes a iterative process where we get smarter. Our bid moves up. They're starting to understand why our bid is the way where it is. Theirs comes down. And I always joke, like the point where the buyer's a little uncomfortable where they're at and the seller is a little uncomfortable where they're at, that you just created the banked process because you iterated through it. You created the market clearing price just through time and work and understanding, et cetera. So, but back to the like, not everybody's built to work this part of the market. Like a big firm doesn't have the patience for that. It's just not their game, right? So that's why I think time and those type of elements are a big part of this part of the market.
And given where we live in the market, the very, the low end of the, institutional market, we have a very high bar to get to LOI for a founder-owned business.
Well, yeah. I mean, we just ran these stats because it's kind of that time of year, but in the last 3 years where we feel like we've been very consistent in how we're doing this. I think we've submitted 6 LOIs. We own 5.
Yeah.
So 5 out of 6, like we're picking our spots
and
we know what we want. And yeah, if we're engaged on something like that, we have an angle. We probably have an executive. We know we've got a good relationship with the founder and we're going to submit and we're going to win for the most part.
We've submitted that bid knowing this is going to get done.
Yeah, we've already because
we spent months, maybe years talking to that owner before we've submitted.
And I don't tend to put a piece of paper in front of somebody and have it surprise them. Like I've probably had a conversation about it's going to be more like this and this is why, versus like somebody waiting, hitting refresh on their email inbox and then, oh, there's a PDF and then they open it up and it's like, surprise.
Yeah.
Like not really our game.
And we're giving it to the owner, because they now actually have to share something with a lawyer. So that's why
it makes it real.
That's why we're writing
I think that's an emotion for a founder. I think that's an emotional moment. Like the founder mentally is selling their business when they sign the LOI
100%.
in our market. Because they're like,
100% agree.
I trust this person. They're going to get this done. They've told me it's going to be painful. It's going to be more painful than you thought to get from here to closed. But like the emotional moment for them, like, okay, we're going to try to do this, is that moment.
Signing the LOI.
Yeah.
100% agree. All right. So how much modeling are we doing before that? Like there's some shops that model every deal that comes in. I feel bad for associates who work at firms like this, where every deal that comes in, full deck gets put together, full IC memo, full model. At my age, my models will get smaller and smaller.
Right.
And I'm really looking for like the what matters here. I don't need 50 assumptions on a page and then tweak them to kind of get to my the return I need.
Yep.
I'm really like, is this about, do I have to accelerate growth here? Do I need to improve margins here? Do I need to, reduce costs here? Like, what am I trying to do here? And what's the lever that moves things the most? That's kind of the get to that conversation with the founder. Kind of really, you don't really need to do models for that kind of stuff. But when you're modeling it, it's like, I'm just trying to get rough and tough here. You're at 50. My math is like, I'm at 40. Let's do some work to try and close the gap.
Yep.
Right. And then by LOI, we've done full blown modeling with all the different scenarios, upside, downside case. What do we have to believe? All that stuff. But at that time for us, maybe different in other firms, our operating team has also been inside this business for weeks and weeks, and they're putting their post-ownership plan together and we're kind of underwriting our team's post-ownership plan rather than the founder's projections. Is that fair?
Yeah, I think we're pretty straightforward. There's an existing inertia to the business. That's your starting point. There's a growth rate that you've figured out for the industry. So you're either gaining share or losing share based on your relation to that. And that's kind of the top line. And then for the and then we have an operating plan. So we're going to make some investments that if it's in sales and marketing, that probably changes the trajectory of the top line. And then we've got some investments in the rest of the business, and how does that affect margins and how does that affect top line going forward? So we definitely don't overthink it. I mean, there's definitely a false precision at a certain point. I mean, if you unleashed an analyst on a model and you gave them 50 variables, the compounding effect, like they're making, like none of those decisions they make on a model makes a huge difference, but That's also dangerous because an associate might be really excited to do this deal. And it's like they could just put one pinky on the scale in little increments for 50 assumptions and make that model look better or worse, right? At the end of the day. So it's got to like pass the straight face test at the end of the day. We want to be sophisticated enough where like a lender or we just understand like what resources are being put against it at the end of the day and how it all structurally works. But we're definitely not like over modelers by any means.
Given where we live and what we do and the things we like, our operating capabilities, we're definitely in that margin of safety.
Mm-hmm.
Obviously, we're going to have a highly precise model for ourselves, for the lenders, for others. But we're also going to laugh at it in a year about how wrong we were. A big piece of it for us too is like, how much investment do I need to put into this business to change the trajectory of it somehow? And the business may not be able to just handle that level of investment. Like, oh, we really like this business, but we got to take it way down in EBITDA or take it negative for a while to get there. And we just maybe like, that's too much.
Yep.
So let's quick talk about lenders. So not all of our deals have lenders when we start, because some lenders are like, let's see it. You're changing the trajectory of the business. I need to see some proof first. Or it's a little too small. Let's get EBITDA up a little more. Let's get past 10 million of ARR and make it easy. So in the maybe it's like a half and half.
More, a little more than half of our deals had no debt
when
at closing. But the other 45-ish% did.
So when it does, like, when are we starting to talk to lenders to get them ready? What do we need to provide those lenders? Like, and how are we picking a lender? Take those.
Yeah, I think if we're kind of making that, so we'll just talk for us. There's the bigger the firm, lending's a huge part of it. But it's also bigger assets and it's much easier.
You have a whole capital markets team.
Yeah, exactly. So we're kind of like ignoring that part of the market.
Totally.
But for us, it's a binary decision. Are we using debt or not? Okay. So,
and you pretty much know that up front.
Yeah, we do.
This deal could probably handle some leverage and we should probably use it because it'll help the return.
Right.
This deal couldn't handle leverage because it's too small. It's too funky. We need some time before we go bring in a lender.
Yeah. So early on, so if you're saying, let's assume you say
yes. Are you calling
yes.
a lender like, I had a great meeting with management. Hey, Marinon or Eldridge, you want to talk about this? Like, how soon are you getting them involved?
I think in general, if you're kind of like, we're going to spend some time on this, you're not going to ask them to do work, but you're going to send an email to 3, 4, 5 and say, we're looking at a company in this space at this size.
Or the general metrics.
Yeah. But lenders like certain spaces and don't like others too. Like we've done a state and local government deal, which was fine. But the second you say government, they're like, is it federal? Just like examples like that. There's certain things they're on and off on.
Totally.
Exposure to cyclicality and things like that. So you just want to like check yourself, like, is this a lendable space even, at the end of the day?
So you can get some feedback. Oh, we were in a deal like that. It worked out great. Or you get some like hand raisers. We don't do anything that's got federal exposure. We wouldn't do something with that kind of retention profile. It needs to be a little bigger for us. So you're like, oh, okay, let's not waste my time on these guys who are putting their hand down. Let me spend some time.
Yeah, but you're kind of marching to put a price in front of a founder. If that price relies on leverage, then you want to have some idea, can I get leverage?
Totally.
But then you're kind of like, all right, sit pat till what you're probably telling them like, we're good until we sign an LOI and then we'll catch you up with us at the end of the day. Maybe you have a model that you kind of run past them and things like that. But they really draft off us. We do a lot of work. We do it ourselves. There's not a existing book in our part of the market. So they're in our space, they're probably going to draft off our work. Our work probably isn't prepared enough for them until we've started some confirmatory work. They really don't start work until the accounting report's done.
Which means you're not showing up with an LOI in our part of the market with a lender ready to go.
No, you
have some sense of appetite.
For us, we've got a sense of what we know and don't know and the risks to that. So we're kind of vouching for our own ability to get leverage in place just based on what we've seen in the relationships. And you definitely don't want to get over your skis there, and we don't. But yeah, and in a good process done well, management doesn't spend a lot of time with the lender. We're not over levering things anyway. We're not trying to get that last 10%. So try to keep it in a comfortable place where we can get it. It's going to be some work. All the ongoing shareholders will benefit from that leverage because it's a cheaper cost of capital, right? And we have access to hopefully some liquidity. some cash so we can invest.
And
But
what do you care about most with a lender?
yeah, price isn't number one. It's really more flexibility and trust. It's kind of flexibility and trust. Like, okay, we've got leverage. Is it a reasonable enough price? Okay. What are the covenants? Does this give us enough wiggle room to hire that person we didn't think we need, but now we need? Or could we, it takes a little longer to get the go-to-market motion going, et cetera. So for us, and if something doesn't go perfect, do we have a relationship with this lender where we've worked it out,
So we're generally seeing a revenue covenant, like a ARR covenant, and a liquidity covenant.
Yep.
Like you can't go below this.
maybe an
much cash.
EBITDA like floor,
Yeah.
that type of thing. Or sometimes there's cash flow lending and it's more of an EBITDA covenant and a liquidity
But
covenant.
if it's like SOFR plus 4 or SOFR plus 5, that's not going to kill the deal for us.
No.
Yeah. Just because we're not pricing it to perfection, we're not levering it to perfection, and we need some wiggle room because we're bringing in new management teams. We're going to find something 6 months into the deal we didn't find in diligence that's going to maybe got to hire somebody else. Something cost, a customer churned out of the blue. We can't have a deal that's in the penalty box. Right.
Yeah, and oftentimes we're going to get leverage later. When we do consolidations, we're doing a consolidation now. We've got our second business under LOI. We might use a little bit of debt, but that third deal, we're going to use debt, a lot of debt, or that type of thing. So it all depends.
All right, and then diligence. Let's just knock real quick through diligence because we'll do.
Yeah, you sign an LOI, this confirmatory diligence. Yeah, what's on that list?
Yeah, so IOI, maybe we've spent a little money, right? But not a ton. LOI, yeah, depending on, again, most of our processes, it's 1 or 2 people. If it's banked, if it's an LOI with a founder, obviously we have full exclusivity. We're the only person working with them. So tech diligence, we're hiring Code & Co. or one of the guys we've worked with to come in and like look at everything under the covers. At our firm, there's an operator running alongside them and driving that and putting their value creation plan together while they're doing the diligence. You and I aren't doing the tech diligence with a vendor and then sending it over, closing the deal and saying, hey, Jim, here's the report. Good luck, right? Commercial diligence, meaning like how big is the opportunity? Who are the customers? Who are the competitors? Market share, go to market. How does the engine run, right? Finance, tax, big issue oftentimes. Are the numbers, right? Does the math, or are they things in EBITDA that need to come out, need to go in? They probably had some add backs or some one-time things. Are those actually legitimate? Legal, all the things you would expect, maybe some things you wouldn't expect. We want to understand, are the people good people? Do they, we want to do background checks. We want to look into their business practices. We want to know that they have all the contracts and the contracts. We bought a company, we're like, oh, we don't have contracts with our customers. We just send them an invoice. And we were just like, okay, how do we underwrite that?
Speeds up the sales cycle.
It does when you don't have to get somebody to legal to look at the contract. We
turned out to be part of their secret sauce.
We wound up owning that company, but that was a thing.
Yeah.
It's like, we don't actually have contracts. It was like, you could have told us that a few weeks ago before we signed the LOI. And then talent, that would be like assessments, background checks, all those kinds of things. And we have found some very interesting things when you do talent diligence early. And then it's all like, what's red, yellow, green? And a lot of our stuff is kind of like amber, one way or the other when we start. And again, we'll do individual episodes on each one of these things, probably with a lot of the vendors we use to go through it. But let's finish up with just like war stories from diligence. Things only a seller could know that we found out later.
Yeah, just to categorize them, there's back to we only know what we know. Like we only know what you've told us, what a seller has told us at the end of the day. So then you do go into the confirmatory stage, and there can be sometimes there's things in there that they know, and sometimes there's things in there that they don't know, or just we're naive to.
Yes.
So
we will say most founders just didn't remember that thing,
right,
or maybe they were holding it back. Right. We've seen some pretty gnarly tax things. I would say in software, often comes up sales and use tax because. I'm just selling. I have a company in Illinois. I sell software everywhere. I don't have any employees anywhere else other than Illinois. Why do I need to pay taxes to the state of Texas or California? It's like, because they told you have to.
Yeah, and it's a judgment call, and there's a materiality threshold and things like that. So yeah, usually people are selling their software in like 40 states. And a lot of times there's some states have $1 million or $2 million of revenue running through them. And then there's some smaller ones, and then there's kind of a long tail that has between 75,000 and 200,000 of revenue running through it. So that's just always a dance with a buyer that says like which one, you make a list of which ones you should be filing in. There's a materiality threshold. You come to an agreement on how it's going to get cleaned up, and you kind of go from there. But it's just common, even in our deals, like there's still judgment calls as we've grown, and that type of thing. So,
and we know how to do this. Most sellers don't know how to do do it. Right. They don't have the advisors and the helpers. So for us,
there's systems, there's
that may be part
filings,
of the gap. We're at 40, you're at 50.
Right.
Well, really, you're at 48 because you have $2 million of cleanup to do. We'll do it for you, but like you got to pay for it, stuff like that. Open source software. A lot of people are like, I just use open source. Well, you have to have
there's different licensing rules and things like that. So, but we wouldn't know that until we do a code scan and just know everything that's in there.
Yeah, and what about like risk tolerance of the founders or the management team we're trying to back? Like,
a lot of that can come out of that could be references, or that could come out of different tax returns and things like that. So we've had founders that you're buying a business for a certain price, and then you get in their tax returns or a background check, and they have quite a bit of debt, which. Again, that happens. This is America. There's plenty of debt to go around in America, but that can be an indicator of like how much risk do they take?
Yeah, if you knew there were liens against the owner of the business personally, I would do a lot more financial diligence and legal diligence.
Yeah, and it just gets into what are your motivations and what are your goals and how do you run your personal life, how do you run your business, et cetera. So, and
then like security, cyber, other things like you get in there like, oh, there's credit card numbers and flat files in the application, right? A vertical software business with built-in payments. Oh my goodness, they're storing the credit card files in the application. That would be risky. Needs to be remediated. Again, we can put dollar amounts on it or risk stuff. But these are things you don't know until you're in the guts of it.
Yeah, and then other things can just be cleaned up. Like there's certain training. Most industries there's just a level of like awareness and policies and training that employees need to go through. Those are things that. Sometimes it's remediated pre-closing. Sometimes you just put a plan in place to do that going forward.
Totally. And then we can do a whole episode with our insurance friends about rep and warranty insurance.
Right.
Which you're like, forget all about all that. You don't need to worry about that.
Right, exactly.
We'll take the risk on that.
Right.
Working capital, funds flow, real quick. Like these are the technical things that like a first time, maybe it's a fundless sponsor, maybe it's a first time fund. They were never in the lead doing these things. And you get to like the end and you're like, oh goodness. Okay. Working capital and funds flow. I think smart people say, let's talk about working capital real early. Maybe that's even part of the
we should. I did a whole piece on this. It's on our website now, just on working capital. My advice is just write the methodology at the LOI.
At the LOI.
Yeah, at the LOI. There's no reason not to write
not just
to define it.
We expect you to have a reasonable amount of working capital in the business to close. We're paying $50 million. That's not good enough.
No, you should say let's do a 12-month peg based on the numbers that come out of the LOI, and et cetera. Like there's a method that is pretty straightforward that we do every time that we can easily call out at the beginning. Now we'll fill in the numbers later. And this becomes, if you don't do that, this becomes the contentious, like founders are always like all their friends tell them like, cause they've been sometimes you can really game it.
Meaning you can use working capital negotiation as a price cut or they can use it as a price. You can
come up with 15 different, you can come up with a definition of what AR, like if you wait, you can say this type of AR is kicked out. This type of accrual is this. We're going to hit you with tax on deferred revenue because we have to deliver the service. There's all kinds of things you can do later. I'd say pull it up front. Define it at the LOI, then you do your confirmatory diligence and you fill in the numbers.
So Q of E comes back. Everybody agrees. These are the numbers. We all look at it. They can tell us, no, we disagree with this. We disagree with that. We agree. These are the numbers. And then you just run it through the formula you already established in the LOI.
The reason I like that is otherwise, if you don't do that, the founder's stressed out about when are we going to get to working capital? When are we going to get to work? Like it's like it becomes the thing.
Yeah.
Versus like we did this at the LOI, the numbers are going to be what they're going to be. I have a whole spreadsheet where I can walk people through where like there is no winning and losing.
Yes.
It's all on the net basis. You either get the cash or you get it's just, so that's a whole thing we could do a whole nother podcast on, but like do it up front.
And your lawyers and accountants looked at this at the LOI and we all agreed this is the right. This is the right formula. We're just pumping in the numbers that we all agree are the right numbers.
Yep.
That's a good, smart thing. Pre-closing prep for like owning it. Again, a value creation plan. Hate the term. Understand that everybody uses it, the VCP. We'll get into this later. This is just like what is the fund's plan and management's plan to do with the business after we own it, before we own it. This is basically like, the pre-mortem
Yep.
What are we going to do with this thing? And that often drives a lot of this, all the decisions that get made, certainly early until you find out actually what you own.
Yep.
But we reference that throughout the entire investment period. And then here's my pet peeve and why it's on this list. That we'll again do another whole episode about it, is employment docs and like onboarding management teams. Like, do not wait till after you close the deal to like show your management team their employment docs, their employment agreements, their equity agreements, how it's structured, how they make money, how they get fired, what happens in the case of cause, not cause, all that kind of stuff. You and I get called all the time by current private equity executives for other funds asking about how to negotiate their employment stuff.
Yeah, it's one of the top ways we've been meeting new executives.
It literally is one of the greatest sourcing
Right.
machines ever, which is send me your
free
document.
advice. Yeah.
First of all, it gives me great,
With lots of caveats that I'm not a lawyer or an accountant.
100%.
But I'm pretty good.
but I find out new ways to screw over management every time I see one of these. It's fantastic. So I can add to my list of tricks. But often it comes like, I literally had a call with somebody the other day. If I don't sign this now, we can't close the deal.
Right.
And it's got such a nasty non-compete in it that I can't sign it. It's probably not even enforceable in the state of,
Right.
wherever, Illinois. And I have it 48 hours before close. And I've been told I have to sign this employment agreement or we can't close. You can close without signing the employment agreement.
Yep.
So oftentimes we believe in management. We're partners with management. We trust management. Oh, and we're going to stuff the management team right before close because we'll get to it. Yeah, we'll get to it. My view is like, at least lay out a term sheet of what the employment agreement is going to look like. You may not have it signed at close. I would say you probably should, but maybe you don't need to. You should have the terms outlined again, so you don't look back and management doesn't feel like you pulled a fast one on them or you rug pulled them, just like on working capital.
Yeah, and it's not always done deliberate. Like founders do this kind of by accident too, because they're worried about getting people too excited about the deal closing and things like that. So the negotiation, the discussion we're often having with founders is, we care about the senior team. We're trying to back them going forward. Like, can we get to this sooner? They're always a little hesitant to do it because they don't want to can't put it back in the bag, and they start working for you and things like that. But I err on the side of like transparency and treating people like adults and like, let's get this to them sooner because, listen, we know a lot and we're going to close this. So like, let's just start doing this in an orderly fashion. So sometimes it kind of happens by accident, but I would encourage people to do it sooner.
You want to freak out a management team? Say, we'll get to that after closing.
Yeah, exactly.
Right, don't do it. All right, so two things. The closing call, the most anticlimactic thing in the world. Back in the day, in the 90s, you would walk over to Kirkland and Ellis. There'd be a big, long table of documents.
Yeah.
You would walk down there and you'd sign them. Sometimes you'd have to sit there and read every single one, and you'd sign, go around the table, and everybody would go do that. It was kind of fun because you got.
I did one where we did that, and then the side doors opened, and there was a steak dinner. There was a steak lunch.
For real?
Yeah,
that was amazing.
yeah.
I've never
It
had
was a
that.
strategic deal. We were at the strategic deal. I won't name it, but we were at their headquarters.
That's
Sold them
amazing.
a company, and because the family really wanted it.
Yeah, that's awesome. So welcome to the new world, man.
Yeah,
It's done over
that's
Zoom.
not happening anymore.
Yeah, it's done over Zoom. It's like, congratulations, everybody. You're a
Right.
multimillionaire.
Yeah.
And then it's like, okay, thanks, everybody.
No, and I've never sold my business. I always warn the founders. I'm like, that's going to happen, and then you're gonna hang up, and it's gonna be lonely. It's a little lonely. You're like, that was it, But
Yeah.
So you get to that later, and you can celebrate
At least
later
when
and all
it's
that. But in that moment, and then you have to wait 3 hours for the money to clear.
at least when it's in person and you have to steak lunch,
Right.
if it takes 15 or 20 minutes or a couple hours delay, like now it's just like they keep moving the Zoom meeting
Right.
an extra 10 or 15
Right.
minutes, and you're just like, this is driving
Right.
me
And
nuts.
you're watching your legal bill just go up.
Yeah, exactly. And the founder's
Right.
sitting there like, well, I thought we were closing at 8 o'clock this morning.
Right.
Why is it now
Yeah, it's usually
8:15? Why is it 9:45?
right.
It's just like,
Exactly.
oh my gosh. So that's just frustrating.
Right.
But then you have the closing party often, or closing dinner where you get together.
Yeah.
So like, we've got so many funny
Just
stories
know
about
that's
this.
coming.
Like, just give me a few of those. So we own the business. It's a week or two later. Maybe it's the day we close, whatever, depending on what the owner of the business wants to do. And we fly down there, and I'll just give it my favorite.
Sure.
Is I step into the company. This was a founder who did not want anybody in the company to know. So only like the CFO, the CTO, and the owner of the business knew that he was even for sale. Family-owned business, passed down a couple generations. I get introduced by the CEO, and she said, and she's standing up in front of the entire company at a podium in like the lunchroom, and she starts bawling, absolutely bawling. It was a very emotional process.
Yep.
I totally understand that. And then says, "I've sold the company. Devin, do you want to come up and say hi?"
Right.
And I was like, oh my God, that is literally the worst introduction I could ever get.
Now you know it's like
it did not appear to be tears of joy.
Well, you know what it's like. You're an up and coming comic, and you're working the cellar in New York, and you're about to go on, and Dave Attell comes up and says, "Here, I'm going to go first."
Oh, rough crowd, man.
Kills the room, and then you're like, "All right, all right, good luck."
Yeah, total cooler, man. She just like cooled the room. So I'm standing up there like, oh my gosh, and I'm looking at the CEO we're backing because she was retiring, and being like, what do I do with this? So that was one. And then we went outside and sabered champagne bottles. It was like a tradition in the family that when something great happened, a grandchild was born, a wedding, they would like saber a champagne bottle. Like I grew up with pacifist parents. I didn't even have like toy guns, let alone a saber in the house. Yeah. So I'm holding a wet bottle of champagne, trying to like do this saber thing. Yeah. So I just decided to just chop the top of it off. Right? And then the whole thing
Nobody drank that champagne.
Oh, it just disintegrated in my hands.
Right.
I was like, and then we had a pizza party. And then on the way out, the owner it just made tens of millions of dollars. She handed me the receipt for the pizza party. Amazing. Yeah. All right. Give me yours.
No, I don't have any like that quite, but I think in general, you realize very quickly there are company traditions. They're going to try to put you into those company traditions. We've had one where they had ice cream Fridays. So I did our little spiel during an ice cream Friday, but which was fine. And you get some questions like, "Are ice cream Fridays going to continue?" But you do realize like these people,
you don't get questions of like, is my salary going up? Have my benefits changed? And what's our maternity leave policy?
They might get a few. You might get a few of those.
Are we still doing ice cream Fridays?
Yeah, exactly. But in seriousness though, like you do realize, so you're telling the truth. Like for us, it's like, we're going to tell you how it's going to be. We're trying to be transparent. This is how it's going to go. This is what we know. This is what we don't know. Looking forward to get to know you. There are a few people that will ask questions like that and the ice cream Fridays. And then everybody else is like, okay. And they're kind of writing down mental notes, and they're like, all right, we're going to watch you for the next 6 months and figure out if we trust you or not. So like what you say in that meeting, they're going to hold you accountable to hold that up. So we do try to be thoughtful about that, but plenty of interesting company traditions that come at you, and you learn ways to gather people that you might not have thought of.
I would say for anybody listening or watching, do it in person. Because when you're doing it on Zoom and half the company doesn't have their camera on,
right,
it's just so demoralizing.
Yeah.
Is at least in person, they could stare at you blankly.
Well, and
you can try and get them to laugh.
97% muted mics, and there's just no back and forth.
Yeah. The whole doing these over Zooms is talk about a letdown.
Right.
It's hard to inspire anybody over Zoom these days. So, all right. So this is the crazy world of how to buy a company once you have a fund, especially in the lower market, but I think a lower end of the middle market. But I think these apply to a lot of people, and we'd love to hear other people's stories about this. The next in the episode is like, what do you do with a company now that you own it? So Jim and Paul are going to walk through the VCP and kind of how they stage the stuff they need to go do after we buy it.
Can't wait to hear it.
From the heart of Chicago to all over the globe, a couple private equity geniuses, they share what they know. They love to mess with technology where the future is sink or swim. It's the Private Equity Funcast with Devin and Jim. Technology issues and middle market PE-backed companies, they bicker with each other and they don't take themselves too seriously. It's not venture capital, it's private equity. It's the Private Equity Funcast. Pour yourself a drink and have a seat. It's the Private Equity Funcast. That equity is private. If PE excites you, let it show and do not hide it. Now the Private Equity Funcast is about to begin. So give it up for your hosts, Devin and Jim.